How did we even get a plane with our name on it like that?
I used the company card.
Frank, what? How much did that cost? Actually, you know what? We're at the beach. Don't answer that. Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now. Man, Frank, we finally made it down to the beach this year. What do you think?
I think this is a really great setup.
No, Frank, we're at the beach. We came all the way down here. What are you doing on your phone?
But check this out. It's a really great setup on gold right here.
Our EDGEFINDER summer sale is now live. Get 50% off all of our tools like commitment of traders data, economic data, and our top setups algorithm for 50+% off using the link being dropped in the chat right now or the description down below. Don't miss it. This is our biggest sale of the entire year. All right, everybody. Welcome back to another live stream. Hope you're doing well. And happy Tuesday to you. You know, we have just 9 minutes to go before actually Papa Powell is taking the stands. 9:30, and at the same time you have Christine Lagarde from the ECB making a stand as well. So they're at the same event. They're at the policy panel at the ECB forum on central banking in Sintra. Anybody been to Sintra before? I don't know where Sintra is. Sintra is in Portugal. That is beautiful. I'm sure that Powell is going to hit the beaches after he gets done. He's going to run the printer while he's at the beach. He's going to say, while I'm gone, while I'm at the beach, just run the printer. We'll be good. Anyways, we've got just a few minutes to go before that is potentially going to move the markets. I think what I might do today is I'm not sure. I'm not sure if we should stream watching it or if we should just keep headlines open to see. Can you guys, let's do a poll. Okay. Let's do a poll. Could we do maybe on YouTube or Telegram, Chandler or James? It doesn't matter, but let's do a poll. Should we watch it or should we just read headlines? Because if we watch it, we can't look at the charts as much. And if we only look at charts, we can't hear everything they say. I don't know. Okay, a lot of people are saying stream, so we got to watch it. All right. It seems like everybody's saying watch it. We'll watch it. That's fine. Can I stream it myself today? And that way I could do like a half and half. Hold on. Let me see. Do we have a live stream today? Chandler, if you can find a link, or James, if one of you guys can find a link for me to watch it, I could pull it up on my screen. That way I could do kind of a half and half. That might be fun. You guys want to do half and half today? Let's do half and half. Yeah, if you guys can find the link, just send it to me and I'll pull it up. But I don't know if it's streaming already or what, but it's going to be somewhere on the internet. I just did a really interesting video this morning. You guys will love it, I think. There will be no hurt feelings, no controversy. But I did a kind of what would happen in a Trump or Biden administration coming next. And to be honest, they're both going to spend a lot of money. So that's you could wrap it up. They're both going to print $1 million. And that is about all that matters. I'm kidding. It is obviously it's a very important decision that the American people will make. But regardless, there will be some volatility. I think a fair middle ground is that most people, I think, would agree that volatility is likely to be higher in the coming months. Why? Well, because the uncertainty of the market going into this debate or this debate last week, but the presidential election cycle here, the uncertainty will likely cause some volatility. It's one of the reasons I still like gold longs. I've held through this choppiness because I think that, you know, the uncertainty case could come into play. We could see, you know, regardless of who is expected to be president, some volatility on that front. But there's so many stories at play at the same time. There's so many potential market moving things. The story with inflation, right? Is inflation going to continue to see progress? We have the producer price index and core PCE numbers. Some inflation statistics are looking better. They're looking improved. And then you still have the CPI, which remains elevated and sticky. So when it comes to CPI, you know, we're still stubbornly in the threes, right? So yeah, we'll have to keep an eye on this inflation story. Are we going to get inflation starting to come down on the CPI level? In which case things would be very optimistic, most likely, because that would precede potential rate cuts in the U.S., which, you know, rate cuts are good for borrowing. It's good for home buying, etc. What time is it at your place? It is 9:26. I didn't mean to incite political violence in the comment section, but you know, just like in 2020, my comment section, unfortunately, is not free of the political fights. There will be political fights in the comment section because, you know, to be honest, I try and do my best to keep things unbiased, but at the same time, you know, even talking about that subject, even though it is very important to the financial markets, is obviously very controversial. Tomorrow there's free 30-minute Zoom calls. It's link in our Discord. Cool. Ivan, yeah, for sure. If anybody would like to get some free one-on-one calls with Ivan going, there should be a link in the Discord. Okay, yes. James, if you could send me that link, I'm going to try and do something different this time. If you could send me the link to that stream, I'm going to pull it up on half of the screen so we can still pull up charts and discuss stuff on the other side. Send me that link. I'll see if I can try and pull it up my side. Join the free Telegram. Boom. Free game. All right, let's see. We'll pull it up. Oh, okay. Let's see. Watch live. Okay. What did I just do? Watch live. My goodness, the ECB. You guys are, is it choppy right now? Hold on. I will reshare my screen. Hold on. Hopefully that's a little better. What am I missing here? Hold on. Privacy statement. I get that, but where can I watch the stream? Watch live. There we go. Okay. All right, guys. We have this pulled up, which is fantastic. What we can do here is I can then go here and we can do a little bit of this action. Let me know if the screen is still choppy. Hopefully it's a little better. Live stream's about to start. So I'll have it up on the screen for you guys so we can watch and also take a look at some charts at the same time. Also, while we wait, guys, just wanted to mention, Z pointed this out. I just bought the EDGEFINDER and it was the best purchase I've made. Hashtag from UK. Z, thank you for the review. EDGEFINDER's lovely. Screen is fine this end. Okay, good. EDGEFINDER fans or potentially new EDGEFINDER fans, if you guys have not heard, we are currently doing our biggest discount of the entire year right now. We're doing our summer sale In fact, maybe while we wait, we'll roll a quick break. If you guys on the producer side don't mind, let's show off some of our, we've worked really hard on these. So please check out our fun little promos. We'll roll one really quick. Check this out. All right, there you go. You know what that reminds me of? I said this to James when he made that. It reminds me of like the SpongeBob episode ending, and before a commercial break, they would roll the little like something similar to that, and it would be like Nickelodeon. Anyways, if you know, you know. If you guys would like access, again, as I mentioned, it is currently 50% off to get a copy of the EDGEFINDER. It is our lowest price of the entire year. We just dropped a link here in the chat. We'll drop it one more time if you guys don't mind. Send a direct message to our team using that link. If you message us while we are live streaming, I got something special for you. It is 55% off. So while we get started here, click chat now. 55% off. You're welcome. Get the discount there. I'm gonna mute this for a second while we wait for Christine. I think Christine's gonna go first. Maybe we'll see. It's kind of the collab of the century. You got Christine Lagarde and you got JP. Both very powerful people in terms of policy, finance, world-wise. Gold and silver slightly down on the day. You got stocks down on the day slightly. Dollar is flat. VIX is slightly higher. Oil is still trending up. I mean, oil was a lot more up earlier. But still up on the day. Oil prices rising. This is something to consider, by the way, guys. Oil prices rising, potentially inflationary, throws a wrench into the story. Yields falling a little bit here today. We'll see if that continues. Bitcoin flat. Ethereum up on the day. So on and so forth. Okay, I'll load it again. I'm going to try and refresh the screen, guys. Sorry.
An anchor at CNBC. Sarah, the floor is yours.
Thank you. Thank you very much. I'm so honored to be back on this stage. We were here a year ago, and it is my also great pleasure to welcome three people who need no introduction in this room.
Girl,
Chair Powell from the Federal Reserve,
girl.
President Lagarde, our host from the European Central Bank, and President Campos Neto from Brazil. This time last year, when we were all talking, you guys were in the sort of final process of hiking rates. Fast forward 1 year, and now it's interesting. While I'm going to miss Governor OANDA and his jokes, we've got three great panelists here going at different speeds, I would say, when it comes to reversing that course. So would love to just open it up, President Lagarde, with you and ask, where are you in this process?
James
because you cut in June. So now what?
Well, it's been a journey. You can't just say, "Oh, we cut in June."
Sound is good, video is bad.
It's coming on the back of a period of hikes, which was unprecedented, facing shocks that I tried to describe yesterday over dinner, and followed by a period during which we held rates untouched, during which we were restrictive enough to actually see our medium-term target reach that 2%, which is our objective. And most recently, we have seen in our round.
Sorry, guys.
We've seen that 2% target with an oscillation of 0.1 about it.
Tell me if this is better. This might be a page thing because James's looks choppy too.
Quarter of 2025. So it's on that basis and on the basis of what I'm happy to describe as, the three-leg reaction function and all the underlying data and information that feeds those three legs that we decided to do a 25 basis points cuts. But in the same breath of air, I also said that it was not a linear process, that it was not a predetermined path that we were embarking upon, but a step that would be followed by further review of data, further understanding of where our three legs reaction function would be. So that's pretty much where we are. And I would simply maybe add that we are very advanced in that disinflationary path, and we are in that sort of slow recovery, which came about during the first quarter and which we hope will persevere. But all of that is flawed with uncertainties and big question mark about the future.
Sounds like you're setting up the market for a pause now. Is that right?
I'm not setting up anything for, anyone. I think that it's for everyone to read.
Let's just try this really quick. Tell me if this is any better. I just pulled it up on YouTube instead of the ECB's page. I don't know if it's any better at all.
To decide.
Chair Powell, you have also been on a journey and have been on hold since last July.
It's better on YouTube.
Have not cut rates like the ECB in June. Why not? What are you waiting for?
So let me say that sitting here last year,
we did it.
We didn't know, and we didn't know that we were just about to embark on a period of 7 months of much lower inflation readings. We didn't realize that the second half of last year was going to be an extraordinary year from a growth standpoint, and also from the standpoint of the labor market. So things actually worked out in the second half of last year in a remarkable way. Then, as you know, in the first quarter of this year, we continue to have solid growth in the first half, actually, solid growth, and a labor market that's still strong, although we've seen a continued rebalancing in the labor market. And inflation, after pausing in the first quarter, now shows signs of resuming its disinflationary trend. So it's a little bit different journey. So where that leaves us is we've made quite a bit of progress in bringing inflation back down to our target. While the labor market has remained strong and growth has continued, we want that process to continue. I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. That's what we've said, and what we'd like to see is more data like what we've been seeing recently. We'd also like to see the labor market remain strong. We've said that if we saw the labor market unexpectedly weakening, that is also something that could call for a reaction.
How much more confident do you want to be? The PCE number 2.6, that wasn't too bad that we got last week.
That's right. So we're actually on a 12-month basis. We're actually at 2.6, both headline and core for inflation, and that represents really significant progress. I think we peaked at 5.4% in core, and the same thing has happened in headline. We've gone from 7.1 to 2.6. So yes, we've made a lot of progress. We just want to understand that the levels that we're seeing are a true reading on what is actually happening with underlying inflation. As we were saying at the last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation, which was well above 3%. So we want to be more confident. And frankly, because the US economy is strong and the labor market is strong, we have the ability to take our time and get this right. And that's what we're planning to do.
So September?
I'm not going to be landing on any specific dates here today. Let me also say that we're well aware that if we go too soon, that we could undo the good work we've done in bringing down inflation. And if we go too late, we could unnecessarily undermine the recession, the recovery, and the expansion. And so we're aware that we have two-sided risks now, more so than we did a year ago. That's a big change. I'd say risks are coming much more into balance now.
President Campos, you have been on a different journey because you've actually been cutting rates for much of the last year and have recently paused. Why? What are you seeing in inflation data, and what are you going to do next?
Okay, so if you go back a little bit in the history of time, so Brazil was one of the first countries to hike rates I think in part because we had a different call on the dynamics of inflation, both locally and globally. And I think that turned out to be correct. And then at some point in time, we started the easing cycle. And throughout this process of easing, we've seen that inflation has converged. We have some of the problems that are common to advanced economies and other Latin American countries, which is labor markets very strong. So there were 2 points of attention. One was labor market being that strong, would that at some point in time mean inflation in the service side? And even though we haven't seen that yet, what we try to do is to try to estimate what would be the components of labor in every service so that we can anticipate if that were to happen. We haven't seen it, but we think it's, there is somewhat of a correlation when you look at the margin. And so most recently, we decided to pause. That had to do not only with the current numbers and with this suspicion that we had service inflation that could peak at some point in time, and also because food prices were going back up a little bit, and I also think that's not only happening in Brazil, it's going to happen in some other places too. But also has to do with a lot of noises that we had. So we decided to interrupt the cycle. More recently, we've had a sell-off in some of the emerging market countries. Brazil was more affected. But I think this has to do much more with noises that were created than the fundamentals. And the noises are related to 2 channels. One is the expectation on the path of fiscal policy, and the other one is expectation on the future of monetary policy. So when you had these 2 at the same time, I think it created uncertainty enough that for us, we needed to interrupt and see how we can fix that channel and how we can communicate better so that we can eliminate those noises. Because there is a big disconnection with the current data, both fiscal and inflation data, and the expectation. So what happened in Brazil is the expectation started to the anchor, even though the current data is coming as expected.
Right. So you're talking about the fall in the stock market and the real recently when you talk about the markets.
But for us, what matters is how this gets into our reaction function. So I'm talking about expected inflation, the long end of interest rate curve. So we had somewhat of a steepening of the interest rate curve. We had a devaluation of the currency. But for us, what matters is the expected inflation, both implied inflation from the markets and expected inflation from the surveys. Those have gone up.
Yeah, I mean, President Lagarde, you have described the path to 2% as bumpy. We got an inflation report in the Eurozone this morning, 2.5%, not too bad, but core was high and services are still above 4%. So what is keeping prices so sticky?
Well, first of all, we had, as you said, a number that was lower than last month. So we said it was bumpy, and it's heading in the right direction for the indicator that we use, which is HICP, to measure inflation and to set our target. So that's good, but we still believe that it's likely to be a bumpy road until the end of 2024. But we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front. You are correct that services hasn't budged. So services is at 4.1, if I remember from the numbers that we got this morning. And obviously, we are very attentive to the components and what is behind services. And the real issue is to understand whether this is caused by sort of permanent changes, or whether it is also a factor of the lag effects of other components, which are finding their way more slowly and gradually into services. And the jury is out as to exactly what it is. The truth of the matter is that we do have a service number that has gone slightly up in the recent months, and which is now staying at this 4.1 percentage points. Now, obviously, we don't need to have services at 2%, because manufacturing goods are below 2%, and at the end of the day, it's going to be a balance between goods and services, and it depends on the weight of those within the index. But we have to look really what is behind it. And what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe, where clearly bargaining agreements are negotiated not only on an annual basis in some country, but sometimes on a triennial basis in other countries. So you have this catch-up effect. For those people whose renegotiation took place early this year, they had not had a negotiation of wages in the last 3 years. In the meantime, of course, inflation went up and their real wages went down. So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window and services are also going to be on a declining path as well. But services is the difficult one.
I was just going to pose that Taylor Swift is touring Europe this summer, and there tends to be an inflationary effect in services. Am I right, Chair Powell? We saw it last year, didn't we?
It's not just Taylor Swift, others have come as well. Larry Spring, yeah.
I don't know. I saw her at Wembley, and there was a lot of spending going on.
Powell probably has an indicator on Taylor Swift's for sure.
The stickiness of the services inflation and how tied it is to wages, which have been rising.
Famously, services inflation is stickier, and famously, it's tied to wages. I would say, so look at the U.S. labor market. We've seen a pretty substantial move toward better balance than we had a couple of years ago when labor was in extreme shortage. So what you see now is an unemployment rate that's moving back up toward a more sustainable level. You see wage increases moving back down toward a sustainable level of wage increases, inflation, and productivity. And you see, vacancies to unemployment ratio coming back to where it was pre-pandemic, and so many other measures I could mention. So that's what we're seeing. And so the labor market, wage increases are still a bit above where they would wind up in equilibrium, but nonetheless, you can see the labor market is cooling off, appropriately so, and we're watching it very carefully. But it doesn't look like it's heating up or presenting a big problem for inflation going forward. Indeed, it looks like it's doing just what you would want it to do, which is to cool off over time, not quickly, not suddenly, not steeply. It's kind of what we've been hoping to see and have been seeing. So, and services generally they're such a mixed bag, particularly non-housing services are a mixed bag. Some of what you're seeing is catch-up inflation from inflationary pressures that happened earlier. That's true with insurance. It's also true with housing services inflation, where you've got some pent-up rent increases that have to work their way off. It turns out it takes more than 1 year for that to happen. It takes several years. So we see all that in train, and we don't see ourselves getting back to 2% inflation this year or next year, or maybe late next year, but in the year after. The main thing is we're making real progress.
Can you keep cutting President Lagarde if he keeps holding?
This girl is hilarious.
Does it make it harder?
Well, look, I'm going to give you the conventional response because that's the conventional question you ask me. We do take into account the spillover impact of whatever is decided by other esteemed colleagues. And obviously, my esteemed friend, Chair Powell, is one of those. So we take that into account, but we also determine, our monetary policy on the basis of what we see in our economy, and we look at the data that we get, the impact that multiple factors have on our economies and its numbers.
Does it matter for you, President Campos, what the Fed does next?
Well, I think it matters to an extent, but I think there is one point that is worth mentioning, which is more recently we've seen a sell-off in some of the EM, and especially the EM that had more, there were more the best cases for investment. And you see that this is being explained with local news. But when you have a lot of sell-offs in different markets and they're all explained by local news, you have to ask yourself if there is a more fundamental factor driving that. And I think there might be. It's difficult to make the case right now, but definitely what we see now is there is more risk premium in a lot of the emerging market countries. And it was very synchronized with the long end of the US curve, and that correlation broke. So we've seen the last couple of weeks that even though the 10-year yield is more or less stable, even actually going a little bit lower, we saw a bit of a sell-off in emerging market countries. And I think that has to do with the fact that as you go for longer with higher rates and much higher debt, you start extracting liquidity
really
from the market,
right now.
and eventually you are repricing that liquidity. It could just be a...
Look at that gold trying to break this level of resistance. I've been watching this thing for days now, trying to break this thing. So we'll see if we can finally get some. I mean, to be honest, Powell sounds kind of dovish. I mean, at least from what I've heard so far. It's why the euro is up. You see the pound is up. Dollar is falling on what looks to be a little bit of a dovish sounding Powell this morning. He came out and he's a white bird. He's a dove today, seems like.
Job in terms of, or at least an equal job in terms of anticipating the process and starting.
Stock market bounced back here. NASDAQ bounced back. US 30 here, the Dow Jones. The real sign is the Russell, which is very rate sensitive. And the VIX tumbling a little bit here. Yields falling. You know, there's the 2-year yield coming down. We've got JOLTS, by the way, in 9 minutes. 8 minutes to go or so. Sorry. We'll see. Could be volatile. We'll see where it goes. But again, gold trending higher here. Stocks rebounding a little bit. Dollar is giving back some gains. And most things will probably rally if the dollar continues to go lower. So it would really put everyone at ease. So we'll see.
Wouldn't you say, Chair Powell?
Yes, I think particularly, I mean, many forecasters had a recession in 2023, which not only turned out to be wrong in the case of the U.S., we had well in excess of 3% growth. So,
but you still see policy as restrictive?
Yes, we do.
How restrictive?
Well, so that's kind of an empirical question. So I guess I would say, if you look at, we do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings, and now a slight softening in unemployment in the form of wages. You see demand coming down, not just the supply that we're getting, but also demand coming down. You also see the effects of high interest rates in the housing market and in some other interest rate sensitive things. So you see that, and I think, I do think that restrictive policy is working hand in hand with this broad supply side recovery we've had, where we've seen the unwinding of the shortages and bottlenecks from the pandemic. We've also seen a recovery in labor force participation among prime age individuals in the US, and then some immigration, which has also been a positive supply shock. So we've seen all those things work together to give us, really significant declines in inflation. At the same time, we've got a strong labor market and growth. This was it's a great outcome for the people that we serve, and it's one that we want to do everything we can to foster.
So why not just cut rates to protect it?
It's what I said earlier.
Is it a bigger risk? Sorry, I'll rephrase. Is it a bigger risk that you cut prematurely and inflation stays sticky, or that you wait too long and the economy loses more momentum?
That is the question. And so, our answer to the question is we serve a dual mandate, right? And these two things are embodied in that mandate. The risk on the inflation side is that you move too quickly, inflation comes back, and we didn't really solve the problem. And then we have to go back in, and that would be very disruptive to the economy. So the other risk is that we wait too long. We understand that, and the labor market softens too much. Perhaps we lose the expansion. So needless to say, we don't want to do that either. So, but at the same time, so we've got to balance those two. And again, given the strength we see in the U.S. economy, we can approach that question carefully. But as I said earlier, though, you see a year or so ago, we were talking about inflation, and our framework called for us to focus on the variable, the mandate that is further from its goal. That's not, they've come back much closer into balance. And a good way to see it is the beverage curve analysis that everybody talks about and looks at. We've come straight down the beverage curve, but you're really getting to that place relative to job openings and hiring rates, where traditionally the beverage curve is flattened out, which would mean higher unemployment as a result of further declines in job openings. So you can't know that with precision, but it's very much understood by us that we have two-sided risks and we have to manage them.
What about the recovery in the Eurozone, President Lagarde? It's also been pretty resilient, especially on the unemployment front. How confident do you feel in sticking this soft landing?
Well, we reached a level of confidence back in June when we decided to actually cut rates by 25 basis points. But as I said in the opening remarks, it's not something that is taken for granted, that is a given, and we're going to re-examine each and every step of the way whether that confidence is actually continuously reinforced in order to continue on that path. And the remarks by Chair Powell made me really reinforce my points about data, because we are navigating in this universe of one risk versus the other, but where data is so important. And data is so important because we proceed always with the burden of the lag of time, whether it's the impact of our policy decisions, whether it's the impact of wages, whether it's the sort of on-time data or not. All of that has to be taken into account and analyzed in details so that we can feel really confident that we can go forward.
At the same time, there are also political risks. Certainly they're front and center. It was nice of all the authorities to make elections all happen this week, certainly in France and in England. President Lagarde, is there anything the ECB can do to shield the rest of the Eurozone from feeling any negative impact from a divided government in France or from whatever the result is of the French election in a negative way?
I thank you so much for your question.
It can't be a surprise.
Because I'm not going to comment on the political situation of any of the member states, particularly those that are facing elections at the moment. But, obviously, the European Central Bank has to do what it has to do. Our mandate is price stability. Price stability is obviously relying on financial stability, and we are attentive to that because this is part of our job, and we will continue to do so.
Does the rise in French bond yields look worrisome at all?
These are the things that we monitor. This is part of the job. It's not particularly at this point in time. We do that all the time, and we are very attentive.
You have fought hard for the central bank's independence in Brazil, and yet now you are the subject of many attacks from President Lula. And so I'm wondering how you're dealing with that.
Attacks from me?
No. No, President Campos. Attacks from President Lula. I think he called you an adversary and an enemy.
Yes, well, I think as a central bank, we have to get away from the political arena and try to go on with the technical job. And I think what we did, is a living proof that everything that was done was very technical. So during the elections in which Lula was elected, the incumbent president, in his last year of mandate, we increased rates in a cycle that went from 2% to 13.75%. That's the biggest increase in rates in an election year in the history of any emerging markets. So if that is not a proof that you are independent and you acted autonomously, it's difficult to find another example like that. So I think all this narrative that the central bank has been political, I think we have to get away from that and explain what we're doing. And I think what we're doing has been very technical. The last decision was unanimous, and we now have 4 members in the board that were chosen by the current president. And I think
I'm going to pause this for a moment. Nothing against our Brazilian friends, but just going to pay attention to the US data for a second. All right, let's see. Jobs, JOLTS coming in here in just a moment. We have dollar bouncing at least. NASDAQ coming down a bit. Wow, look at that. Dollar is ripping. JOLTS came in 8.14 million compared to the forecast of 7.96 million. That is a stronger than anticipated jobs numbers or job openings number. And we've talked about this a lot recently, but the trend for JOLTS has been lower. So to see an uptick in job openings is a strong thing for the dollar, and has a bit of a impact, of course, on the expectations for rate cuts. If the labor market is strong, that's going to push back expectations. Let's see, we got JP speaking.
And do it well. I will say in the United States, there's very broad support for an independent Fed in both political parties on both sides of Capitol Hill and everywhere. I don't think that that's really in question, as long as we just are seen to be doing our job and staying on task at all times.
Can I say something?
Yes, please.
I think that there are countries where governors do exactly what Chair Powell said, and yet get blamed, criticized. And I think that for some, it takes courage to do the job, in addition to being a good, excellent technical expert.
But I do wonder if you're concerned, because your term ends, President Campos, at the end of the year. And it doesn't seem like President Lula is going to reappoint you. So do you worry about the independence of the central bank?
So first, I was never up for reappointment, regardless of who won the elections, and I've said that from the very beginning. When I helped design the independence law, I actually tried not to have the reappointment possibility in the law. And for me, the reason was I didn't want that the president of the central bank at any circumstance would have any incentives to bend his knee in order to have any kind of re-election. So that we need to make that very clear. Secondly,
silver is flying today.
There is actually a risk premium down in the curve, and I think it has.
Dollar jumped initially on JOLTS and has not held those gains, at least for now. We'll see how the candle closes. We've got, this is a 5-minute candle, so we get some time here. Just another note here, they revised the previous number lower, which may be part of the reason why there's not a huge follow through. If you took a look at this and you said, well, look, JOLTS is really strong. Yes, that's true, but they also revised the previous lower. Kind of gives you a mixed response, leaving you with kind of a mixed candle in terms of reaction. Gold, silver, gold was up a little bit here, but it still is up in terms of kind of a overall reaction here. Just because we were down this morning, now price is back to break even on the day. S&P, NASDAQ, both slightly green now. Dow Jones slightly green. VIX 1% up today. Russell's up 0.5%. Again, I would say overall a more dovish sounding Fed. Powell did mention, willingness to or concern about the risk of inflation reaccelerating, but he also kind of equally balanced it out. Oh, he's speaking. Hold on.
U.S. economy, we have 4% unemployment. It's growing at 2%. Inflation's at 2.6%. Let's keep that going. Let's do our jobs. History will judge. I think if we can keep things on that path, that's what I'm focused on. That's the only thing I'm focused on. And as I mentioned, I do think support for the Fed's independence is very high, where it really matters on Capitol Hill in both political parties, among the leaders and most of the following. And so I worry about getting the job right. That's what I worry about.
I know you guys don't want to touch politics, but President Lagarde, it does bring into focus the fiscal policies, right? We heard President Campos say it. There are concerns about the deficits in France, if the far right should win. There are concerns in the United States about the deficits. So I do wonder if you have something to say or to warn on the fiscal front as it relates to making your inflation fight harder.
Well, fiscal matters enormously, true. And it matters in two different ways from my perspective. It matters from a sort of conjunctural type of way, and thank goodness the European authorities have agreed on the fiscal governance that will take over after the Growth and Stability Pact has been suspended and now completely replaced. So there is a framework within which members of the European Union have to operate, have to control the direction of their debt, have to make sure that it is sustainable going forward through the efforts that they deploy, and have to keep their deficit on watch with enough flexibility. And that's the second part of fiscal spending that I'm concerned about, with sufficient of an impact of a focus on productivity, on growth, of investment that will be conducive to both. And my hope is that in addition to operating within the European fiscal framework, which has been agreed by all European members, in addition to that, countries will actually look at the structural changes that they have to either continue to have in their arsenal of tools, but also that they will continue to improve going forward, because I regard that as critically important for productivity purposes, which we are lagging behind and have been lagging behind for a long time. So we're not so worried about fiscal expectations, as Roberto was saying, for Brazil or emerging market economies, but we're very concerned about the fiscal rules that have to be respected within the European Union, and the structural reforms that will be conducive, hopefully, to productivity improvement going forward, because that's the only way for Europe to actually remain strong and thrive in those changing circumstances and transformations that we have talked about.
And I know you're allergic to fiscal policy, Chair Powell, but I have heard you talk about the unsustainable debt burden of the United States. And even lately, there's been a sell-off in treasuries after increasing odds that President Trump will be reelected, that there might be a sweep of either party. Doesn't that make you nervous when it comes to the progress you've had on inflation? If we do see more expansionary fiscal policy, more deficit, bigger deficits, bigger debt loads?
So I'm gonna give you the traditional answer to some extent, and that is that we just don't. Fiscal policy is a job for elected people. We're not elected people, so we don't comment on it, and particularly in advance of a presidential election, we're not commenting on anyone's particular policies one way or the other. I will say more broadly, though, the United States is running a very large deficit at a time when we're at full employment, and it just is. The level of debt that we have is not unsustainable. The path that we're on is unsustainable. That's completely non-controversial. I would have thought that this is something that should be a top-level issue, and you do hear this from a lot of elected officials, but it should be a real focus going forward, is how do we get back to a sustainable path, because you can't run these kinds of deficits in good economic times for very long. I mean, I wouldn't say, I can't really speak to the time, but in the longer run, we'll have to do something sooner or later, and sooner will be better than later.
President Campos?
Yeah, let's do a basic exercise. So look,
whether you get Biden or Trump, there will be serious concerns about spending. Both of them spend a lot of money. So it is, something to think about when you have high, government spending. And Jerome Powell's point right there is very true. It's concerning that, our debt is growing at the rate it is, even with very good employment right now. U.S. employment is like really strong in terms of history. I mean, if you take a look at unemployment rate over, the last many years, we're at, I know this is hard to see, so just bear with me. I don't want to mess up the stream. We're running at a very low historical unemployment rate right now. So during a time like that, where you have a lot of productivity, it is alarming that debt continues to balloon higher, even when things are, relatively speaking, good. It is concerning too, just to drop my 2 cents on it. I don't care if it's Biden or Trump. Both of them don't seem to have any strong policies that will reduce the deficit spending, because both of them have a track record of spending a ton of money.
And I think it's sometimes I stop and I think it's time for us globally to think about a way to get to some kind of stable trajectory of the debt in the next couple of years. And it's not one country or the other. It's something that we need to do collectively, because the global debt is very high and is going to start taking a lot of liquidity from the markets. And the ones that will feel the effect are not the advanced economies, are the emerging economies, emerging market economies. And the low-income countries are feeling that effect already.
And you think the market is mispricing this risk?
I think the market was mispricing a little bit the fact that if you have higher rates for longer, the effect from extracting liquidity, depending on how much longer you're going to have these higher rates, I think the risk is higher than what the market's pricing is.
I also wanted to ask you, President Campos, about China, because you have a pretty good view. It's such a big trading partner for you. What's going on there? How much is China's economy slowing?
I'm not sure I'm very equipped to tell you what's happening in China. I can tell you that is very important for a lot of emerging market economies. It's very important for Brazil. We are a very big exporter of food items and iron ore. So China is a very big trade partner with Brazil, and it has been for a while. And regardless of the government, it's important to understand that is a very important tie to Brazil. The one thing that we look from looking from far away is we're trying to see what are the policies that China is doing, what is the focus, and what is the impact that this new policy will have for us. But because we export mainly food items and iron ore, we don't see that as a big threat. I think some other countries will have a different understanding of what this impact will be.
Yeah, I mean, there's also trade barriers that are going up. President Lagarde, tariffs. I mean, in our election, we're talking about potentially more tariffs. Are you seeing that in terms of growth and inflationary impact?
Well, we're not seeing yet more tariffs than what had been decided back 8 years ago, and which was consistently maintained later on in relation to certain products. So that for the moment is stable. What is not stable at all is the number of protective measures. Occasionally, non-compliance with WTO rules, the level of disputes that are brought before the WTO, which is not in a position to resolve them because they are not equipped with the dispute resolution mechanism, and magistrates have not been appointed to that effect. We've had more than 3,000 trade protective measures decided in the last 2 years. And that is like 5 times what is the normal average of measures that are decided. So that's a concern. And it's a concern because trade has been fueling growth, and because Europe at large is not a small open economy, it's a large open economy, and trade restrictions are going to affect Europe much more so than other countries that operate without this degree of opening and vulnerability in a way. But the second reason I'm concerned about it is that typically trade is conducive to innovation. Innovation is necessary for productivity. And I think that the combination of reduced trade on growth and the impact of trade on the capacity to innovate and to improve productivity is a vulnerability for Europe, and one that we have to address very forcefully if we want to win this battle of productivity. So and it's not independent from inflation. I'm not getting away from my topic, but it's one that is clearly a concern on the horizon.
But and it could be inflationary. I mean, 10% across the board tariffs, Chair Powell, inflationary?
Of course, I'm not going to be scoring any potential political proposals which have been talked about. It's just not our job to do that. Also, almost anything affects the economy. Trade affects the economy, immigration, energy policy. Those are not our jobs. There are other agencies that do those jobs. We do maximum employment, price stability. So in our political economy, we stay out of that.
Right, but has implications for price stability, surely, and maximum employment.
See that look JP did?
Again, we're not looking to be. This is exactly what we're not looking to do, which is to become players on issues like tariffs. I mean, because it affects I mean, literally everything. All these things affect inflation and jobs. But notwithstanding that, there are others in the elected government who are responsible for trade policy. We don't comment. That's all.
Understood. So back to your job then. There's this debate and among the Fed and other central bankers about where policy rates are going, R-starred, the neutral rate, what that rate should look like, and whether it's different after COVID. What do you think?
Can we go back to trade?
Yeah, sure. Please.
You didn't like that one.
So, R-star. I guess I would start by saying that the thing that we write down as part of our summary of economic projections, and the thing that economists mean by R-stars, is a longer run concept. It's the rate of interest that would hold the economy at equilibrium at a time when we're at stable prices and maximum employment, and there are no shocks hitting the economy. So this is not the economy today. So the first thing to say is that when we're sitting in the boardroom in Washington thinking about whether our policy rate is the appropriate rate for this economy right now, we're not battling over what long-run R-star is, because this is a different economy. This is an economy that's still recovering from the pandemic. And so many forces are pushing it this way and that way, and there's really not a lot of precedent. So it's a very challenging time. But it's not the question. The R-star question is a really interesting question, and that is, are we going to go back to the very low levels of neutral rates that we had in the recovery of the global financial crisis? Or are we going to go part of the way back from today's high rates to that? And intuitively, most people think that we won't go back to those very, very low rates that we saw, during the global financial crisis recovery period. But we don't really know. I mean, the neutral rate is moved around, we think, by slow-moving, longer-run forces, demographics, technology, productivity over time. All of those things move it around. Ultimately, the balance between savings and investment. So it's a great conversation to have. But honestly, when we're looking at policy in the boardroom, it's how is our policy affecting today's economy, and do we think we're getting the results that we want? And by and large, in a world where this isn't a world of precision, we think we are. We're getting a gradually cooling economy, a gradually cooling labor market, progress on inflation, 4% unemployment, 2% growth. We're getting kind of what we would want to have. And so that's, I worry that some people, no one in this room, but some people think that the R-star debate is the thing that dictates our assessment of how restrictive policy is. It's really not. Unless you think that the long run rate is the same as today's rate.
I think that investors are trying to figure out, though, where you're going to end up and what the policy path looks like once you start cutting rates. And it becomes important then.
No, I agree. It does. Yeah. It's what will we discover to be? We'll find it empirically. What will we discover it to be? And I think there's a debate going on. There are people who feel very strongly that it hasn't changed and that it has changed, and ultimately it's unknowable. It does matter for the longer run. It matters for where rates will settle out, but it doesn't matter much for policy decisions today, which are the ones we're actually making.
I guess we want to know if they're like 10 cuts coming or 15 cuts. I mean, do you think, President Campos, it's changed post-COVID? Are you dealing with a different economy? So
the R-star story for emerging markets.
We have Chris standing by. Chris, do you want to join in and just listen with me? You're welcome to. I'm just going to listen for a little bit longer. Yeah, let's bring him in, James Chandler. What's up, Chris? How's it going, man?
What up, man?
Just listening to these lovely people discuss monetary policy is all. Just a typical Tuesday morning thing.
Just another day in the office.
Yeah, exactly. I'm taking breaks when nothing against Brazil, but I'm really mostly interested, probably like most people, in Christine and Jerome's comments. So we'll see. What are you watching today in the markets?
I'm watching the same thing I've been watching for the last couple of weeks, which is the 542 lows and the 550 highs. The daily SPX triangle working out pretty well. Just reviewing the portfolio. I'm trying to clean up. I'm really trying to clean up some profits. Just scrape some profits, even if it's a little bit early. Get some additional buying power back, and just trying to think over the next, let's say, let's go E-mini futures here. Oops, not ES. ES is there. So over the next, 30 to 60 days, I mean, part of me is wanting to have just a little bit of a pullback so I can start positioning out of the money. But if I don't get positioned now and we just go up higher, I'm just going to miss out. So I think there's ways I'm still going to look to generate some income, give myself some cushion. I actually had a trade constructed this morning that I could take the E-mini futures S&P, there's an ES ticker, all the way down to 5090. 5090 would be where my trade was, quote, threatened, which would be about 7 to 8% lower, and I could still generate about $450 a profit over the next 30 days.
Do you think there's a potential downside, coming? Do you think that, are you more betting on the downside, or are you more thinking it's, yeah?
I just want volatility, man. I mean, what I am positioned for on the SPY and the Qs, I'm positioned for some movement by the end of July. I think we have the CPI gap right here at 537, and it's pretty notable. Like the CPI gap we had a couple weeks back, we've been at chop for 2 weeks. Price today, not much. Price tomorrow or yesterday, not much. FOMC meeting minutes Wednesday, non-farm Friday. It could be noisy, right? But I just think it technically we're due for a correction. I think the market's still pretty well supported. I don't know how big of a correction we get. I mean, historically, July is pretty bullish. Historically, it's low volume in the summer. I don't know what Powell would be saying to rock the markets. I don't know what the minutes would release tomorrow to rock the markets. Probably nothing. I don't think. And so I just wonder if and you and I have talked about this many times in the show. Can't we just go sideways for a little bit? I mean, sideways is actually okay. And so there's ways to generate profit going sideways. And I think that might be my best option right now, which is just, look, man, if the market goes sideways, I'd rather go sideways to lean slightly bullish. If it goes up and goes to infinity, okay, I'll miss out on some of the alpha. But it's like, if I'm just generating income, we're going sideways. It's a lot easier to be collecting income on a variety of instruments over the next, let's say, 30 to 60 days of this happening, as opposed to trying to get into the trenches and grind out a futures trade every single day, or grind out a 0 DTE and try to trade direction when you're not getting it. So yesterday I traded gold and futures, gold futures, silver futures yesterday. So that was my kind of big trade yesterday. Is I just like where it's at. I think gold still looks good, silver still looks good. I'm just staying out of the way, trying to buy low, collecting income, lowering the cost basis, but I really do want to do something on the indexes. It's just I don't want to get overextended for what seems to be top heavy.
Yeah, I'm kind of in the same camp. I've got this XLK position. I've told you about this in the past too. I still have those calls that I've sold. I've made nothing in terms of gains on this because I've capped my upside with the covered calls, but it's actually looking like if this thing has any downside in the next few days, I might actually be able to stay in my position as well as have collected some premium. So we'll see. I wouldn't mind if the market pulls back a little bit, but similar to yourself, if it does not, if we rip higher, then I just take profits basically. So kind of in the same camp, and we'll see where tech goes. But to be honest, if of all the sectors right now, tech and energy are the only two that I have in the account right now. Would like to build out positions, but I need to see growth and inflation cooling for that to really make its way into my account. That's kind of my position. I've stayed out of a lot of other sectors and things while I wait to see that. Again, I'm a little bit concerned that the narrowness could continue, but I don't think that ends well if you don't see broadening and inflation coming down. So I don't know. That's where I'm positioned. I think sideways is reasonable as people try and figure out, is this economy going to cool or is this economy going to accelerate? I think that there's probably a in between that we stay for a while on.
Yeah, that's a good point. Are you in XLK, XLE as a bit of a hedge? Not a hedge, but like something where one is going to offset the other, right? Tech is up, energy's down, energy's up, tech is down. Those have been nice to kind of have non-correlation, where like the worst days in tech have been the best days in energy, and kind of vice versa.
Yeah, I've got energy. I bought XLE on this little dip recently. I liked the kind of breakout of this downward trend.
Okay.
I like energy as a secular play in terms of like the index. Let me listen to JP.
You see this massive investment boom. You see, serious people in the private sector and the public sector. There's a sense of something big coming here. And it feels like what that will be is it will eliminate some jobs, it will create some new jobs. And the question really is for many people who will it augment their labor and make them more productive, or will it eliminate their job? And I just don't think we know that. It's too early to say. There's not a lot a central bank can do about that. This is really a job for we can supervise our financial institutions and things like that to make sure that that they understand what they're doing with all different kinds of technology. But also, like everybody else, we're meeting with all the experts and asking ourselves what will be the effects on productivity, on inflation, on growth, and will it be enormously displacing, and if so, of whom? One thought is that it'll be more people doing white collar jobs who are writing press releases and things like that. So we just don't know. It's something we're investing a lot of time and effort. We're not using generative AI. We're very carefully looking at that. Other earlier forms of AI are in fairly common use in American business, and I believe we use some of that.
What about you, President Campos? I know you're focused on the energy needs as well.
Well, first, I think when you look at the surveys that we have, and we have plenty.
This is where I take my break from their comments.
You're just a Powell fanboy, dude.
Well, I know, and I was listening to Christine earlier, but I feel like they got out what they needed to say for the ECB, unless there's something surprising or changing there. But yeah, so back to your question about energy. I mean, oil's been on the rise recently, maybe not so today, but we've had a strong increase in oil. Also, yields following the debates have been creeping back up. It's not been good for my TLT position, but it is also something to note that if a Trump presidency happens, it could lead to concerns about inflation. They were discussing that a few minutes ago, actually, on this panel, discussing the effects of import taxes. Could that be inflationary? Could that hurt the relationship between or could that hurt Europe? And just thought that was interesting. I mean, the concerns about inflation, I think, regardless of who you get as president, they both have a track record of spending a lot of money, and that's not even a disputable fact. They both spent a ton of money during their presidencies.
Sure.
Obviously, you had the pandemic smacked in the middle for both of them, but again, I think that it is there is some concern in terms of the inflation reacceleration idea that, as Jerome Powell mentioned earlier, is outside of his decision making. They can't decide what government policy is. They can only decide, what to do with their Fed funds rate and QT or QE.
Yeah, I mean, he can say that, but man, there's going to be a big impact on what that combination looks like, right? I mean, you can have all fiscal, you can have all monetary, but we have had a lot of monetary without fiscal. And just this last, 3-4 years since COVID and since the Fed's been tightening in a way, we've had a lot of fiscal without monetary. So I still think they go hand in hand as far as the best picture moving forward is probably going to have to be some balance between the two. And, the Fed's been pretty vocal and transparent about where they want to be, whether they can do it and orchestrate this soft landing, no landing recovery. We'll see. I'm going to take a second here too. I mean, I'm looking right now for asymmetry in the market, right? I mean, the trades that you have on, the trades that I have on, that I'm looking for, if I'm going out the next 1 or 2 years, where do I think the most upside is? Is it in U.S. equities? Is it in the U.S. broad market? Because I think not. I think that we could be steady. I mean, that's never been the problem, is the U.S. economy, just churns along, and we see, 8% a year, 10% a year. We've come out of terrible crises with huge upsides. 2020, we came out of 2022 at the end of it with a really good 2023 and what's been a pretty good 2024 thus far. And I still think there's going to be better opportunities elsewhere. I mean, there's ways to participate in the U.S. always, But I don't know, man. I'm looking elsewhere. I feel like, positions in gold, positions in silver, gold futures, silver futures, crypto possibly. But we need, like you and I've said, I mean, risk on needs to be a factor for crypto. I mean, Bitcoin is vulnerable at if we break below 55,000 on Bitcoin, I would say we're very vulnerable to the downside, which would not be good. I think that level has to be defended by the bulls. If it's not, and we see a strong break below that without being a bear trap, then Bitcoin gets really ugly really quickly. So I'd like to see just levels kind of maintained. But like I said, I mean, if I'm looking for where's my opportunity to make a 20, 30, 40% winner, where's 100% upside on a certain position? I mean, a lot of my picks are not US, unfortunately.
Yeah, so. And for me, even if I'm in the US, I was just putzing around yesterday with Gemini, the Google's AI thing, and I was just asking Gemini about the long-term performance of growth stocks versus value stocks, and it was a really fascinating thing just to kind of use the tool for that purpose. And what I found is that a lot of value, or over the very long term, value stocks historically have outperformed. And, that's kind of hard to believe in the recent years because it just seems like everything that's exciting, AI growth, whatever, just gets pumped. But, if we enter into a period of sideways market, or we enter into a period in which, uncertainty prevails, like there's just not, easy monetary policy, and there's concerns about the world and what's going on, and you don't have massive growth and tons of stimulus. If that changes, value stocks are probably the place to be, because then suddenly people will fall back on predictable earnings companies, which is value. And, again, it sounds so crazy in recent years because everything is just about growth. But, the long term, there are periods in which we've talked about this many times, Chris, like value can certainly have a long stretch of outperformance. So let me just listen to JP.
Sustainably, durably underlying inflation between 2 and 2.5 is what I would say. That would be a great outcome.
Headline PCE.
Yeah.
President Lagarde, 1 year from now?
1 year from now, I would say low twos. We are at 2.5 latest reading, and as I said, bumpy on the way ahead, but low twos.
You've been closer to 4%, President Campos, right?
What did
President Lagarde?
That would be underlying inflation between 2 and 2.5 is what I would say. That would be a great outcome. I
think it's a 1 year forecast. I think, Nick, where they want to see a year from now.
The
1 year
work that's
headline,
been
2
done
to
is very
2.5
technical.
core PCE. Got it. Or headline
I'm
PCE.
confident that we'll continue to be that way, and I think
interesting. I don't know. Sorry to cut you off, Chris.
No, at first I was thinking like, did he just lift the inflation target? Did he just say we're accepting like that 2.5 and not a sub 2?
Yeah,
but I think it's just what their forecast is for 12 months out.
Yep.
So I think my my plays are China. Options exposure. I mean, if you pull up a chart, Nick, you can look at FXI, you can look at KWeb, you can look at HSI, you can look at Baba, Baidu. I mean, fundamentally, Alibaba and Baidu are pretty darn strong. They make a ton of cash. They have a ton of cash. They're in good financial positions. I think the difference here is, and can you go to like a weekly chart? I'll just look at your screen so we can keep the stream pretty. So, that is a weekly chart in FXI. Nice double bottom. We also had some decent structure where you could draw a lot of trend lines there that have been breaking, right? Like a down trend line that's been breaking, and it looks like price made a convincing breakout come like March, April. But we're clearly in a pullback. I mean, I was a little surprised to see such a big rip in March in China, and then have it really retrace a lot of it. Like FXI has retraced a little bit, but if you look at Baidu, if you look at Alibaba, they've retraced most of those gains, right?
My goodness. Wow.
That's ridiculous. I mean, we had an interesting start to those, and that's back again, like I guess March and April were where we had the big runs, and it's completely retraced. So that was surprising because I mean, again, it's me trading. It's not like the market has to listen to me, but I was really patient on those setups. So because I'd been kind of dabbling and I was in early, and then it got to the point where I'm like, okay, I'm clearly excited about position. I'm excited about the the upside opportunity, but the timing of this could be a year away, could be 2 years away. We might have to see. I have no idea, man. I mean, do we have to see a new president? Does Trump come in and all of a sudden have this great relationship with China? Doubtful. I feel like
the trade war was a Trump thing. So
right, and also I think that we go way more nationalistic. We go way more deglobalized if Trump is president versus Biden, or if there's going to be a new Democratic nominee. I have no idea. But anyway, I mean, it's going to be rough, man. I mean, whatever happens, for better, for worse, I mean, we're gonna have to figure out how to navigate it. I just think on my end right now, it's like it's slowing down. I'm generating some income. That's really my focus. I think what I'm looking at position for is I want to concentrate, get out of some of the fluff, take out some of the exposure. I'm experimenting with some new hedges where when we talked about growth and value, I mean, is value truly outperforming growth, or is it just not losing as badly? Like when value is outperforming, I don't feel like it's necessarily making you money. I think it's just protecting you and keeping you out of trouble.
Yeah, well, there one that comes to mind as just an example is like Target, right? Target actually if we go back just as an example here in the 2000s, we talked about this recently, the long kind of sideways chart that was the the S&P 500, the NASDAQ was way uglier. You're kind of right. Like let's say you bought it in 2000 and you held it all the way to 2010. I mean, it's up, but the S&P 500 during that same time, let's just do that as an example. S&P 500, if you bought in the 2000s, right? So if you bought 2000 and then held to 2010, you're down. So yeah. I mean, that's a 10-year stretch where you would have been.
It would suck either
down.
way.
Yeah. So you would have suffered less. I mean, it's not like it's exciting, but
sure. But there have been some that have look at Alcoa, or look at CLF, Cleveland Cliffs. Look at like a producer. So CLF is Cleveland Cliffs. This is steel. Mm-hmm. Look at that 2000 to 2010.
My goodness. Yeah,
and that's what I would be getting excited about, is stuff like that.
That's crazy,
right?
Yeah, and see, that's the thing is, I think that I've said this so many times on the stream, but we are in a 15-year just exceptional period for the stock market, and if you're talking about doing this for the next 30 years of your life, 40 years of your life, we're probably going to see environments that are not so truthfully very easy markets if you have tech and long high risk stuff, but again, throughout history there are periods where the high risk stuff is just a waste of time. It's dead money for a decade. So I do think that that's an argument for some level of diversification, or for at least in your case, what you talked about, like yielding stuff, maybe dividend plays, maybe selling options for premium. Like again, I talked about this with my dad sometimes, and we talk about how gold dividends, yielding stuff look silly until they look genius. And there will be a day. Is it going to be soon? I don't know. I think that growth could still do its thing for a while. I'm not calling it top by any means, but understand that when the tide shifts, I will certainly be making plays in favor of value and keep some growth in there when it's really oversold kind of stuff, but just be careful when it's so hot and exciting.
Agree. And easy ways to play it too. It's like there's an S&P growth, there's an S&P value, there's a Russell growth, Russell value. So I agree. I mean, there's ways to play both. I think as we see the market go sideways too on the SPY, I really think the structure is very clean. I would personally love to see like a 2 to 3% pullback, possibly if we still fill the CPI gap that's like 3%, maybe 3 and change. But the floor isn't broken. I mean, the trend that we've been seeing since October of last year isn't breaking. The little pullback and the rip we had from April's pullback to May's push and drift in June, I mean, nothing is breaking. So, like I said, I mean, it's July. I mean, we've been seen nothing but trends basically since 2019.
Yep,
2018
exactly.
was a steady uptrend. 2017 was the 1 year in history that the S&P went up every single month and never had a down month. It was like the weirdest, slowest grind melt up, but it wasn't a huge year. And then 2018 we had that 20% dump at the end of the year. 2019 was Fed backstop. It's like we've seen nothing but just crazy highs and lows and booms and busts and the Fed's backstop and everything. And it has made the market so sensitive, man. I mean, it's like the economy shouldn't be the most exciting thing in the world. It's like, it's nice it hums along. It's nice it does its thing. It's nice that we see a 54% baked in bias. So I guess outside of a black swan, outside of something we clearly can't control, trades that I'm doing are either trying to position for ownership way cheaper, trying to generate income if we go down a little, sideways, up a little, up a lot, and just keep trading, man. I mean, I guess when you have profits that are rolling in regularly every 30, 45, 60 days, it offsets your trouble. If you've got, debit spreads, like bear put debit spreads that will help you hedge a little bit, it helps. I mean, so I guess that's what I'm looking at is I'm just going to continue to kind of engineer my profits where I have steady income, but I also have some hedge plays or down plays where if we do have a turn, I have things I can pay pretty well. And what I do own, I wish I could say that everything I own, I'm just looking for unlimited upside, but I've got covered calls and pretty much everything, and I've got puts and everything, and I'm just trying to, try not to lose my butt. I mean, if they're going to turn, I don't want to see my P&L fluctuate. If we go up, I want to see it be steady. If we go sideways, I'm going to be steady. So that's just what I don't know, man. That's what I'm feeling in the market right now. I need to be really protective at this point in time. And it's not like there's a top around the corner. I mean, I'd like to think that by the end of the year, regardless of what we deal with, the market's going to try to do its best to go higher. I think the Fed is potentially able to break it. If the Fed doesn't raise rates, I mean, we haven't talked about oil this morning. Oil is up 17% from the low in June.
Yep.
Nobody's paying attention to this. And all of a sudden we're talking about inflation. Powell forecasts out, 12 months and says 2 to 2.5. Well, what about the numbers on actual and CPI data? What about core is excluding energy, excluding food? Well, what about energy? Because we've just seen it rip up 17%. I noticed at the gas pump, everyone notices oil prices are higher, gas prices are higher. That's sticky, man.
Yep, that's for sure. Well, Chris, I gotta hop off. But before I step out, I'm gonna just go ahead and we've got the link ready to go. There it is. Boom. Guys, if you're new to the stream, Chris comes on regularly and helps us out. He hosts a component of the show here, takes over for the A1 show. And if you're not already following him, he does have his own social media. He's got Chris Pulver Trading on YouTube. We just dropped a link to that. And if you're watching on Twitter, it is at Real Chris Pulver. Last thing before I step out, guys, remember the EDGEFINDER 50% off sale is ending soon. This is our biggest discount of the year on the tool. Get access to all of our data, top setups, COT data, economic growth data, all the labor statistics, all sorts of seasonality data. It's all in one tool. If you haven't already picked up a copy, it is 50% off. We'll send us a message on this link right here. It'll connect you to a member of our team who can help you get a copy and get set up with it if you have any questions. Again, that is 50% off. So take advantage. And Chris, you got the show for a little bit, man.
All right. Thanks, Nick.
All right, man.
Have a good day. Hey, bye-bye. All right. Let's switch over the screen here and let's make sure we're showing my chart. So I want to take a look at XLE in addition to some other sectors. I mean, this is not a bad one. I think Nick is playing it solid with kind of two opposites where, tech and energy are the unmovable objects and unstoppable forces. If oil is up, this is good for the energy sector. I do think that you're also sitting on some of the biggest contributors to the energy sector are cash-rich, dividend-rich companies. I know that probably one thing that would be best moving forward, it's not like we need to see the XLE sector go into full ESG mode, which is your environmental, socially responsible, blah, 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 that sounds great on paper, but nobody cares about at the end of the day because all shareholders want are bottom line numbers and all corporate profits want are profits. So ESG it sounds great, but an energy company I mean, in truth, an energy company like a Chevron, like an Exxon, they should be pretty active in, alternative energy. If they're going to push into wind energy, solar energy, they're going to push into nuclear energy. I mean, Europe is making a big push back into nuclear energy. Anyway, I think that your largest companies with the most resources will be the guides. And so I hope that there's a way to balance out, finite resources and fossil fuels as opposed to new energies. But point is, there's a lot of good dividends within the XLE sector. There's cash, healthy companies with very low debt that they just make a lot of money. And so what is ridiculous is to see that I want to say NVIDIA is showing more. I can't remember what the exact, I think, oh yeah, it's NVIDIA's market cap is more than the entire energy sector combined. Every company in the energy sector is less than NVIDIA all by itself. So, and yet revenue wise, NVIDIA is like a third, a fourth, a fifth. It's dwarfed by the energy sector. Energy sector, profits and cash is huge compared to NVIDIA. So, call it overvalued, maybe. Speaking of NVIDIA, here we are. So NVIDIA is at 121.90. We have had, I would say, lackluster excitement in NVIDIA since we had that top at the end of the month in June. So we had our sell-off right here near the end of the month. We had about a 17-18% correction. NVIDIA's pretty much sideways. It looks the exact same as SMH, which is your semiconductor ETF. I mentioned before, gold and silver. So I see a lot of people chatting here with gold. And I do like gold. Call me gold member. I'm not that bullish, but I am bullish. And so what I took yesterday on gold, let me go into gold here. Let's go into, there's my symbol. All right, so gold futures. Let's start with one position. There we go. So I did a staggered credit spread. So I did a 2280 by 2270, so a 10-point wide credit spread, and then I did a 2275 by 2265 credit spread. The plan on this is to protect probably half the profit. I collected $4.70 of credit in total. So over the next, let's say 30 days or so, maybe I can see about half of that profit. If I can see over 50% of the profit, I'll probably take it and redeploy it and do something very similar. I like gold kind of maintaining this area. I think as long as we maintain a floor around 2280, 2275, gold still looks pretty good. And also trend line support wise, if we have lows from October 2023, a higher low in February of this year, and if we go sideways, I think gold, if you give it enough time, we're going to talk about gold making all-time highs once again. So I am positioned for gold to go up. Okay. So I like gold. Silver, similar. I did the same thing in silver. So if you go to GC, that's gold futures. Okay. So there's my gold futures position. And the 2280 and 2270 is just underneath this recent chop. So I get it. Like that may be vulnerable in a credit spread, but it's pretty defined risk. And if I wanted to go out further in time and I wanted to go out further down in price, ideally I would say I'm still going to maintain a bullish outlook on gold as long as we stay above $2,100. So if you're looking at the gold futures market, as long as we're above 2,100, I'm still pretty bullish on gold. Okay. You go to silver ticker. If you go, let's go XAG first. So here's your spot price. We're at 29. Silver is hanging in there, again, after a little bit of a correction. I've been long since this, kind of $22 level, got a little bit more aggressive on the $26 breakout, had a nice run on some SLV long calls. And now I'm looking to get some ownership. I want ownership of SLV, and I'm close to getting it. By July 19th, I'll have probably some, but I have a 29,876 all staggered puts. If we get assigned or I get assigned, it's going to be somewhere with a break even. Let's say I get assigned at a 29.2827. Okay, or I get assigned at a 29.28. Well, right now, if price stays where it is and I'm assigned, I don't get assigned at 27. I don't get assigned at 26, but I get assigned at 29.28. So my break even is going to be on my tranche of shares, 28.50. I can then put in a collar, have upside protection on a call, have downside protection on a put, or I can just hold it. And I don't think right now that there's any reason for me to be necessarily bearish on silver. I'm not going to collect the type of premium that I want. I don't think the downside would be huge profit potential. Now I can protect, but for me, silver still has a really good looking channel where if silver makes a run towards 32, I could see this channel high hitting around 35 or 36. My measured move on silver, and this is why I like silver more than gold right now, that measured move is about 64%. So as I mentioned early in the show with Nick, I'm just looking for opportunities where I see a decent upside. Okay. Silver at 64% to get to my profit target, that's a pretty good upside. I don't have a lot of stocks I can confidently say this thing's going up 64%. It's not measured, right? We're talking about stocks at all-time highs. Stocks at all-time highs that annualize maybe 8 to 12 to 15% a year. It's going to take a while to get to 60% gains, you know? Having these blowout moves, I mean, a Russell 2000, maybe the small caps show some big gains. Your IWX is your Russell 200. That is far outperforming. So IWM is your 2000. IWX is your 200. And you can see that this is blown through the all-time highs previously that we had back in 2022. Okay. But a lot of stuff is getting toppy. You know, this looks fairly toppy right here, where, you know, I'm hoping that this is an ascending wedge. So we have a nice rip. Okay. Ascending wedge would be this. Price is going to stall, and we see if we can blow this high off. Okay. One good thing to celebrate this year's market would be if we have another blow off run, you're going to be so happy you stayed in and participated. If we give it all back, this is what I am potentially positioning for, is I don't want to give it all back. I've had a good run this year. I've got a great half of the year. I don't want to give any of it back, you know, and I may not be, you know, netting profit necessarily, but if the market dips 5%, 10%, 15%, I essentially want my P&L to be sitting near highs, right? I want my watermark to be sitting near highs. I don't want to give it back. I want to be hedged appropriately where I'm just protected. And then I can reestablish, you know, buying things at a discount and just kind of weathering the storm. So if we blow off the top, I obviously want to participate in that as much as possible. If we go sideways, I'm generating income. We go down, I'm just trying to make sure that I'm not losing my shorts like everybody typically does, right? The market dumps 10%. Most people's portfolios get crushed. I'm not trying to be that trader. Okay. I'm trying to be protected either way. I saw somebody mention something about Nike. I'm not sure if Frank is jumping in with me, but I think he's looking at taking a position on Nike. I do have a position running on Nike. I went out to 2025. I basically did a leap contract where I sold a 60, I sold a 55, and I sold a 50. Look, if I can own Nike at a COVID low discount, which we haven't seen that low since 2017, I'm going to take some shares of Nike. Frank was talking about doing a bull call spread on Nike, which I do think is a pretty good play. Just depends on the timing of it. Let me see if there's a decent little value I can find on this trade. So if we went out, let's say 45 days, okay, and we kind of do this like it's a split trade. So we're trading at 75. This actually could be pretty perfect. If I were to buy Nike at 70 and then sell it at 80, okay, if Nike stays where it is, you're going to maintain roughly, it's going to be break even. If it stays right where it is and doesn't go anywhere for the next, 45 days, you actually have full value built into the trade. Okay. If price goes up to $80, you're going to make $4.30 in the trade because you're maxed out at $10. If we have a gap fill, gap fill on Nike comes up to $88. Full gap fill comes up to $92. We had that $92, $93 before the break. Is there risk in the trade? Sure. If Nike continues to go lower, yeah, there's risk in the trade. Your risk is going to be the full debit you paid for it. Okay. But over the next 45 days, if we go nowhere, it's break even. We go up to try to fill this gap a little bit, it's up, right? Maybe this is the market saying, hey, look, we overreacted on the words of Nike. I know they missed in revenue, but they beat in earnings. I just think that their forward guidance and their message is pretty clear that, there's a slowdown from the consumer. They've had some supply chain struggles with China, and maybe, I don't know. I mean, that's about the extent of my, of my trade, other than I saw price drop the way that it did. So I think the bull call spread is interesting. I think it's valid. If it stays where it is, it's break even. If it goes up a little bit to try to fill the gap, you make a couple of bucks, and that's a good return. If it drops lower, this is where I'm positioned. We come down to 60, 55, and 50. This is what I currently have running on Nike. So my positions here, if I go to Nike there. So I just have cash secured puts. That's all. So I collected 375. I'm trying to generate a quick, 15 to 20%. I'm not looking to hold these for a year. I just went out the year to collect all the premium up front. But if we go sideways and we just chill for a little bit, then, maybe I can grab a quick 70 cents to $1 on this trade over the next maybe 30 to 45 days. So I like that trade. It's pretty effortless, and I'll just manage the position. I'll take a look. So it's only been a couple of days. I put the trade on last week when the news first happened. So that's where I'm at. Crude oil futures looking good. Gold futures is stable. I saw some questions on New Zealand CAD. Somebody asked me if I'm long in the pound Swiss, and my answer is yes. I'm long still against the Swiss on everything. So, my Aussie Swiss has turned nicely. That's bullish. It's had a nice little turn from this recent low around 58.60. It's now up to 6,000. That's a 140 pip turn on the Aussie Swiss. I'm long and continue to stay long. I'll even show you a quick snapshot of what I did in my trading room. One of my courses I launched called Portfolio Builder. All we're trying to do is build positions on the currencies that I like to invest in. And so this year, I'm investing against the Swiss. I'm long Aussie Swiss, long CAD Swiss, long Euro Swiss, pound Swiss. I'm long. I'm maintaining. I didn't add new trades. But last week, I put in some buy limits, some buy stops across the board. So Aussie Swiss, new trades, CAD Swiss, new trades, Euro Swiss, new trades, pound Swiss, none. But pound Swiss has good upside to me. I'm looking for the pound Swiss to hit 1.20. New Zealand CAD, I'm holding long. Aussie CAD, I'm holding long. New Zealand Swiss, added some new trades. Dollar Swiss, added some new trades. So why? Positive swap. Swiss National Bank has been more dovish than others. They've cut twice this year, which I think is great, right? I mean, great for this divergence in monetary policy. One thing that's going to be really interesting, and I mentioned this yesterday in the show, and I don't know if it stuck. Maybe it did, maybe it didn't. Okay, we're at 161.43 on the dollar yen. Do not ignore the potential event that the yen can bring. And what I mean by that is, look, right now, the dumbest thing you can do is try to call the top and the yen crosses. All right. I didn't really know this as a trader. I've traded the yen, on and off for a long time. I've hated it probably more than I've liked it. And I've certainly made more money not trading it than I have by trying to trade it and be wrong. The yen is a ruthless currency pair that if you are wrong and you're trying to fight the flow and you're swimming upstream, this yen will absolutely kill you. Okay. Maybe not literally, but it gets close. You might have some extra gray hair. You might have your heart pressure, your blood pressure and heart rate go up a little bit higher. It's brutal. Okay. But my point is, I do think that, yes, this has been a pretty easy carry trade since 2020. It continues to be a carry trade through 2024 as we're halfway through the year. If we get to the end of this year, we typically see carry trades unravel in that 2 to 3 year window. Happened back in 2008, happened back in 2014. Happened back in 2020 very quickly, happened in 2022. We typically see like these 2-year cycles. I wouldn't be surprised. And again, I say all this, and this yellow box up here is representing the rate of change of the Japanese yen as opposed to a price level. Everyone thought when they first intervened back here in April that now 160 is going to be the peg. 160 is going to be the fixed rate that the dollar yen won't go above. That's the dumb outlook, because you can clearly see the Bank of Japan doesn't care about 160. Right? Neither does price. So what I measured was the last time we saw these big interventions, we typically see like this 9 to 12% window to depreciate the yen. And when it happens fast enough, that's usually when we start to see some intervention. Now, is intervention what we should be dealing with in Forex? No. That's what's so frustrating is we shouldn't have to be trading currencies and trading anything that's this highly manipulated. We can't control this, okay? But what is an easy trade, in my opinion, would be right here. If we put in a decent top, oops, I'm not drawing that very well. If we put in a decent top, let's say in this area where I'm hovering my mouse, what I would love to see is if we put in a top here, right, and we go down and we pause, okay, if we break, retest, go, that is going to happen fast. So there could be a 1,000+ point move on the yen that maybe happens in 1 or 2 months. And to me, rather than chasing and chasing and chasing and chasing and, oh, cool, I'm up 100 pips, I'm up a couple hundred pips, I'm not that interested in those couple hundred pips. I don't care if we go to 165. I don't care if we go to 170. I'm not that interested in this grind higher, okay? I'm more interested in making sure that in the event that we have a huge repricing of the yen, that I'm profitable on that I'm hedged on that I'm levered on that, and also I'm protecting the risk-off event that will likely bring with it, okay? So that's another reason I'm cleaning my portfolio up. That's another reason I'm making sure that I'm not caught on the wrong side of a crazy sell-off if we get something. I mean, a lot of things are up in the air, right? Who's going to be the U.S. president? What's going to be the fiscal and monetary policy combination? What about geopolitically? Are we going deglobalization? We're going globalization. Probably the latter, or probably the former. Probably deglobalization. Probably every country for themselves. Geopolitical tensions continue to remain high, right? Tariffs, imports, taxes. Ugh. Exhausting. We just have to trade. But if you keep your trades mechanical, focus on the P&L, focus on probabilities, trading tends to work out. And usually you can perform as well as the market, even taking small risks. And you can also outperform the markets by having a trading account, having some margin to work with. Okay. Todd's asking about euro dollar. Go ahead and type in some requests and type in some requests if you have them. I'm just checking over to see if Frank's jumping in. Maybe he got all burnt out yesterday from the AC. But gold, we did gold. Yep, I'm looking bullish on gold. Medium to long term. I'm just looking at support levels to kind of buy nice and low. We're still sideways on the day. The SPX was centered around. Let me check this trade out. By the way, we're up to 24.78. Let me see if this point move. So I centered a strangle at 24.70. We're only up about 8 points. Probably in the next 30 to 60 minutes, this trade is done for a 15% take profit. All it is just a very quick, in and out over maybe a 60 to 90 minute period, grabbing about 40, $50 on a quick time decay. Chicago Fed. Okay. Thoughts on pound CAD? Yeah, I do like not this chart here. I do like some CAD trades. So I'm currently, this is interesting. So I'm long Aussie CAD. Okay. I like long Aussie CAD. I'm also long New Zealand CAD that I'm looking to see, and look, the New Zealand's been performing pretty terribly. It's weaker against the Aussie. It has been doing okay against the Euro, but it turned recently, or I'm sorry, the Euro New Zealand turned recently off the lows. Pound New Zealand's turned a little bit. New Zealand dollar is weaker than the Aussie. Okay, so my Aussie New Zealand is still long. I bought this around 108.30, 108.35, and I just moved my stop loss to break even or better. I'm trying to trail this a little bit. If I go to the New Zealand CAD, I still like this trade overall. It's certainly not a trend-friendly currency pair. It usually is not. But if we have a swing from this low to high, I'm looking to see if this is a low, high. We've formed a higher low. I'm looking to see if this will stay in a channel to get back up to the same high around 8,800. So I'm still long on this, and I'm looking for a turn. So if we zoom in on this New Zealand CAD, all I'm going to look for is an aggressive trend line. All I'm going to look for is, some of my trending indicators that I typically use, moving averages, for example. If they turn and go bullish, I'll buy the New Zealand CAD. I'll add more to it. I'm already long. I've been long since this trend line break. I've been long at these equal lows. I bought in this swing around the 50618 fib. I'm long. I was sitting on some really good profit. I was up about $500 for my account. And I'm looking to see if I can double that by getting to 88, and I'm going to try to add to it more to make that even bigger. So I'm picking my battles here on the New Zealand CAD, but I still like the bullish side. Short bias is looking. Euro pound, I think, is reacting okay. So I took a trade here at 84.80, so that one got filled, and you can see the price is responding okay to that. So this is now a sell trade. So that's a sell trade at 84.80, stop at 85.50. It's positive, not by much, 6 pips. I'm not excited about that. But my stop loss out of the way, if price responds, I'm looking for this. So we had a nice break of support, come back to retest. Let's see if we can revisit that same support and possibly go lower. If we look left on this chart, there is another lower low down here towards 82.80 or slightly lower 82.50. So that's where I am at on the euro pound. I'm just looking to see if this breakout, break, retest, go, okay, if there's some legs to the downside, or if it's just we broke, we go sideways now, and we stay between the high around 85 and the low around 84. We could also see some chop. This is not a currency pair that likes a trend, by the way. You know, what I'm hoping doesn't happen is that this is a full-on break of 85, that's 85.10 all the way down to 83.90. That's a 120 pip breakout, which on this currency pair is pretty big. And if we all of a sudden snap all the way back up and get above 85 again, then good riddance. I want to be out of the trade. But hopefully it's just clean structure on the euro pound. Crosses here, euro CAD and pound CAD. I like both of these trades. I talked about these in my flex trading room. I think the pound CAD looks a little bit better. The euro CAD, I'm looking for something like this. If this is a head and shoulders trade, left shoulder, head to neckline, right shoulder. If you want to trade this, I like this neckline break for a measure move. This would be a nice spot to be looking for profit on the euro CAD, somewhere down here. But it had to be a neckline break. If I get in the trade, I'm putting a stop loss above this right shoulder U-turn and then measuring my move towards this previous low. All right, so I do like the euro CAD. It's not ready yet. I'm not taking the neckline break yet because it's not confirmed, but I do like the setup. Pound Canadian. Pound Canadian. Also, I like 7,800 better. I like 7,800 better to sell as opposed to now, but I'm watching. Okay. On some of my trend indicators, if we go back into a red alignment to sell, I'll probably take a pretty simple sell trade, stop above, go after a little bit of a swing scalp, maybe take it down to this low. So I'm looking for some type of risk reward that's favorable, something like that, where this is my profit on the downside, then my risk is a little bit smaller, maybe a 2-to-1. So I'll be watching those, but I am looking for a euro CAD and pound CAD sell. Euro pound, I'm already short. Euro dollar, Jin's asking euro dollar. Euro dollar, just look at the DXY. Okay, dollar index, it's making higher highs and higher lows, but man, it is freaking choppy. So dollar index is not easy, right? Euro dollar, I'm short euro dollar. I shorted after CPI news. Let's go euro dollar. So my stop loss on the euro dollar is 108.50. I shorted around 107.50. So I'm up a little bit. We had a French election gap. We filled that gap. I'm looking to see if we can break these lows at 106.60. If we can, is it possible to come back down to this previous low around 105 or 104.70? We'll find out. But currently I'm holding short. I'm looking at the posture of the DXY. It is July. I don't see this being a big topping time or a bottoming time. I think this is more of, what is in motion stays in motion. Since we had this turn here in June, the dollar's been put in motion, and I'm looking to see if that will continue a little bit higher. Okay, that's my thoughts at least. Dollar index. Would I love to see it get up to 108? Yes. 108, 108.50? Yes. That would be a nice grind to then sell the crap out of the dollar. Currency-wise, I tend to be an investor in currency pairs. And so when I get a big direction and we get this big fundamental and technical alignment, man, you can make a lot of money in Forex. In between, it's just a lot of surviving. I trade a lot of robots for that exact reason, because I have currency pairs that don't do anything. They just range. And so if those robots just range, then I try to just grab some range profits. McCann, dollar Swiss. Yep. As I said earlier, I'm long against the Swiss. Dollar Swiss looks pretty good. Where to? I'm long the dollar Swiss all the way up towards 96 and 98. That's my profit window way up here. If you're looking at measuring this, it's a low, high. Okay. If we have a pullback that still plays out, I'd like to see this kind of left structure, right structure area offer some symmetry to take me up to this pocket. But I am long. I bought in at the 382. That's working out pretty well. I was long in this trend line break. I was long in this equal low. I've added a bunch of buy stop levels to get filled on higher highs. I also have a trend line break that I'm stacking some orders up here to take profit at my profit window. So if this is a push, I'm trying to take advantage of it. That's my profit. But I'm long dollar Swiss for sure. Long dollar Swiss. Yep. Okay. So just a quick little recap. I mean, currency wise, I'm long against the Swiss. Japanese yen wise, I'm waiting for a bigger repricing, deleveraging event. Maybe it's later this year. Maybe it's early 2025. I don't know. It's probably going to be something on the coattails of the Fed. You know, we still have the Fed in September. That's going to be the big one. We have minutes tomorrow. Probably not a lot's going to be revealed. We have non-farm on Friday. That is one thing I would like to take a look at. The forecast is not crazy awesome. Okay, so Forex Factory going into this week. Let's just go high impact only. So we have non-farm. This is ADP non-farm, which is the precursor tomorrow that comes out at 8:15 a.m. We have unemployment claims for the U.S. as well. We have seen a pretty steady amount of unemployment claims. Okay. Quits aren't necessarily happening, but unemployment claims have been happening. We see FOMC meeting minutes at 2 p.m. I think we're having like a dual stream tomorrow. I think I'm going to be on at 10 a.m. and 2 p.m. So we'll talk through a couple of segments tomorrow to see if there's some aggressive price reaction. And then Thursday, it's a U.S. holiday, but we have parliamentary elections, CPI for the Swiss, which I think will be interesting because we just saw 2 rate cuts out of the Swiss this year. I'm hoping there's more. If we start to see, it's not going to be a race to the bottom necessarily, but I do think that we go from, you know, this aggressive 2-year hike cycle to pausing to now starting to cut. And how extreme, excuse me. Last night I had some terrible traffic, and I didn't get home until like midnight last night. I played golf. James, if you're listening, Drew, if you're listening, I played my first round of golf this year. After I broke my arm in February, this is the first round of golf that I played. Played 9 holes, shot 3 under. So I guess I can still play. But anyway, that's for you guys. What was I talking about? I'm tired. Just kidding. Okay, so Thursday, U.S. holiday, but Forex is still open. Crypto is still open. Watch some key levels, set some chart alarms. Friday's non-farm payroll. Okay, non-farm payroll. Is it good or bad? Right, 196 forecast revisions. Let's take a look at these recent trends. So we expected 238, came in 175. Expected 182, came in 272. That revision, you know, that's quite a big change. I mean, I don't know. The non-farm numbers then have been pretty stable. So it's probably just going to be stable. You know, we'll probably print 150 to 250,000 jobs. If it's better than that, great. You know, strong labor market, maybe. But I don't know. I mean, what you have to read tomorrow, it's not, or on Friday, it's not just employment numbers, but it's average earnings. Is average earnings higher? Is the unemployment rate down or up? Okay, this has been a trend that I've been watching as well. If you go to the graph of this is the unemployment. See if I can I zoom in here? Oh boy. So we had our big peak there during COVID. Once we settled in, I mean, we've been staying right around high 3s for a while. I think the lowest it was like 3.4. Is that right? 3.4, 3.2. Let me get rid of this. What was our lowest? 3.4. That goes out for the last year plus. If it was any lower than that, I'd be surprised. I think our lowest was about 3.4. Yeah, that's what I'm seeing here. Okay, so 3.4. There's been an interesting stat when it comes to recession, and that is if you've seen a 1% move within a 12-month period, that's not a good sign. So the last time we saw those 3.4s, that means if we get to a 4.4, you know, again, it's within that rolling 12 months. So it might take a lot to get us there, but a couple things to take away, not just from non-farm job numbers, but you got to look at average hourly earnings. You got to look at the unemployment percentage. Is it trending higher? Is it stickier? We'll find out. Okay. Do you trade the Japanese stock market index, the Nikkei 225? I was looking for, there are some ways to trade it. Let me see here. I think it's a BlackRock Nikkei. You can trade Nikkei USD futures. That's not too bad. So /NKD. That's probably the way that I would trade it. If I wanted to trade it, I would just grind in the Nikkei futures market. So let me see if I have that in. So that's /NK /NK. So I've got natural gas futures, and I've got E-mini NASDAQ futures for the NQ that everyone knows well, the MNQ also for the minis, or the micros rather. It looks like I don't have, in my Tasty account, I don't have the NKD. Let me see here. iShare Nikkei. There are ways to get some exposure. I personally don't have any positions running on the Nikkei. I talk about the index because it's been a pretty fascinating story of what the Japanese yen has done as a currency and what the Nikkei has done for, I mean, it seems like, oh my gosh, it's been in a drawdown for 34 years and it finally broke all-time highs. It did, right? And this has been an incredible run, but it looks like you think, oh my gosh, the Japanese economy did so well. It's up 390%. So let's take this low, by the way, which is in 2008, okay, 2009. We had a bottom here in the Japanese index, and again, tested those lows multiple times, and even into 2012. But if we take the bottom, okay, the bottom to breaking all-time highs for the first time in a long time, you have a 466% move. Now, let me go to the actual Nikkei 225, just in case. So it's NI 225 right here. And let's take the same window. So let's go to the bottom, which was in 09, and take this up to current price. About a 430% move. Now, that's a massive number. So a decade, you just quadruple your earnings. Awesome. Okay? Look at the S&P. I mean, the U.S. has been a beast when it has come to these lows and this performance. You got to give the hats off to the U.S. for just being ridiculously resilient. I mean, this is up almost 700%. The U.S. in that same window of finding a bottom in 2009 has, almost 8, or I guess it's 7 times your money. Okay, time in the market is better than timing the market. We're sitting here going back and forth of, I think it's going to pull back. Look, if all I cared about was the next 10 to 15 to 20 years, I should just buy it and freaking who cares, right? But the difference is I do care because it doesn't just, for me to say I'm buying today and I don't look at it for a year, that's obviously not what happens, right? Day in, day out, week in, week out, month in, month out, quarter in, quarter out, year in, year out, I'm in the trenches, okay? Now, I do carry a bit of a bias with me because the market goes up. The market finds a way to go up. The market has ignored everything that we've ever had in this country, right? We've ignored world wars. We've ignored, high and low volatility. We've ignored monetary policy, all sorts of drama. I mean, everything, right? Right now, look at all the crap the market ignores. All these things, it's like it's being carried by 3 stocks, right? But it's at all-time highs. So who cares? What's the problem? So that bias is important to carry with you because that will be, that's literally your 54% edge in the market. If you go to a casino with a 54% edge, guess what happens? You play as many hands as you can because time is on your side, as is the edge, right? But trading doesn't give us that. That's what's so incredible about the stock market. If you just stay in it, 20 years of any given history in the stock market, by the way, makes you money. Okay, I'm going to show one thing really quickly. I don't know if it's on here. I've got it on my other computer. By the way, I did buy a new computer. I'm not on it right now. It's going to be shipped to me next week. I built about 1,000% improved trading computer. I've had my workstation for the last 10 years, 11 years, and it's been great. But after seeing some memory leaks and other stuff, I'm like, it's time for an upgrade. The RAM's not doing it anymore, and I need a bit more of a supercomputer. So off we go. But to answer PM's question, do I trade the Japanese market? No, but I watch it closely. I watch the yen. There are ETFs. I know there are ETFs. I know there are CFDs. A lot of companies that are big in Japan are also in the U.S. as multinationals. So there's ways. I mean, if you traded a Sony, for example, or you traded Toyota, for example, it's like there's ways to trade Japan. But I get it. Like the index might be great. If I could trade NKD, I would. But I'll probably just stick to Japanese yen futures and the yen as a Forex pair. Okay, pound Aussie. Pound Aussie, I've got a couple levels I'd like to see, and then I'll wrap it up. I got to run here in a minute. So pound Aussie, this is what I'd like to see. I'm waiting for a trend line to break and see if this actually behaves. So if we hold this level, I'm looking to see if the pound Aussie just ranges back up towards 94. I would like to see this if it's offered. Okay, let's say that the trend doesn't break. Let's say this trend line doesn't break, and we go down and down and down and down and down and down. This level would be fantastic. If we find that support, buying that low, take it back up to that range high, I'd like that more. Just because it's better reward to risk. You know, take a small risk here, have maybe a 2 to 3 times upside. So I'd like that trade ideally. But if we get on the right hand side of this trend line and head higher, I could see that with a trend line break. So that's my outlook kind of intermediately on the pound Aussie. But watch the trend line. If we don't break the trend line, don't confirm the trend line, there's no trade. For me to buy it, I got to see confirmation. Have I looked at dollar yen? Yes. Yen crosses are this. If you're trading the yen, you can go to any system you want that's trending, scalp the yen, and stay bullish against the yen. Okay? The one thing you got to be careful of, make sure you have some stop losses in. You don't want to see some type of intervention level. But like I said this yesterday. I'm reiterating this today. I don't think that the yen intervention comes until we're sitting at 165 or 170. I'm just making a guess. This isn't a forecast. This isn't a prediction. This isn't financial advice, right? I do not want to be positioned or trading a crazy flash crash move. I don't want to be trading some type of, intervention, because here's where I think it gets even trickier, right? Let's say we have another intervention level and it's around 165, but it spikes up to 175 and then flashes all the way back down over the next couple of days for 1,000 pips. Good luck trading that, So my point is, for the dollar yen, if in any yen cross, look, they broke out those intervention highs from April. If they keep grinding and grinding and grinding, you can go down to a 1 minute, 4 minute, 15 minute, 5 minute. I don't care. Scalp the darn things bullish and just keep making profit. I'm serious. Like, if this thing's going to keep going because the rate of change isn't that aggressive, just keep grinding profits. Okay. And if the stop losses are tight, if the thing has some nonsensical moves, you get stopped out quick and you lose small. But for right now, you get a lot of reward to risk that's favorable by just having a slight bullish bias, because that's what these things want to do. They want to drift higher. Okay. And as PM said, I don't bother with the end cross anymore. Me neither. Okay. The only trade I'm interested in at this point is I don't scalp. I don't day trade in Forex. I'm usually, more of a swing trader, more of a position trader, more of a position builder. And that makes me a lot more money consistently year after year. So I don't get into the trenches. I rarely leverage my Forex account. I traded a lot of IRAs in Forex trading, managed accounts, and I don't need to take that type of risk. And so I'm very conservative when it comes to Forex trading. So I invest. I trade small, build small. I'll build up, micro lots to mini lots to standard lots. And then, I'm adding to it the entire time as it's going my way, and all these patterns are coming to fruition and turn some nice profit. Okay. Percentage, how much profit you're making on an average. So I have a prospectus that I send out some clients, and I've been averaging about 19.6% a year. That's been since 2014 managing money, about 19.6% a year. So, and that's net fees and everything. So, it's better than the market, without a lot of risk. I mean, my drawdowns have been pretty contained. I usually, if I get in, Forex, I've had some drawdowns in Forex. I traded through Brexit. I traded through, COVID. I traded through, the oil crisis. I've traded through yens and dollars and baskets and all sorts of wild stuff. We've had flash crashes, but turned out okay. So yeah. But yeah, about 19+%. So just shy of 20, but that's net. So it's pretty good. I think it is. It's freaking a lot of work, but it's all good. I enjoy it. If I didn't enjoy it, I wouldn't do it, but I will say that you got to be mechanical. It's just making trades that you win, you lose. You keep trading. You know, no one trade's going to be the make or break. I'm never going to be a roaring kitty. I'm never going to be a meme stock trader. I'm never going to be a YOLO or diamond hander. It's like, I'm just a trader. I believe in the sample size. I believe in the slight edge. I believe in probabilities. I think that's how you make money long term. You know, I want to do this for the next 40 years. You know, not 5, not 1, not bet it all on whatever stock you think is going to be great and you lose everything. Maybe you make a fortune, but good luck. I mean, if you have no idea what you're doing, it's you know, the market doesn't love you back. So you start making mistakes, this market will humble you very quickly. So that's why I believe in having a plan that revolves around, you know, strategies with edges, strategies with probabilities, and sample sizes where you can take hundreds and hundreds and hundreds of trades before you ever really get in real trouble, you know? So, Shai, I see your question there. If anybody has questions on that stuff, you can just contact me, reach out to me. So I know they post my YouTube channel. You can join my Discord as well. My Discord service, Chris Paul, we're trading. And if you jump to my Discord, you know, you can message me or we can talk about that offline. But yeah. But this, I mean, there's a lot of places to find me, but yeah, usually that's conversation. I like to know who I'm trading for. I trade for a lot of friends and family that became referrals. So I know all my clients very, very well. It's not just open for business. So it's really important to me that there's expectations set because this isn't easy. Okay. All right. Hey, everybody. I'm going to let you go for today. I'm going to jump into my other trading room for stocks and options. We got some stuff to talk about, and we'll go from there. Okay. Come back and join us tomorrow. We're going to have a combo session. I think I'll be on in the morning, and then we have F1C minutes in the afternoon. So I believe A1 Trading will be streaming for quite a bit for the day. So tune in, have fun, and thanks for being with us today. And thanks for being with me. Appreciate being here, as always, and talk to you soon. Thanks, bye.
Attention A1 Trading Show fans, if you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.